Welcome back to the Deep Dive. Today, we're really getting into the nuts and bolts, the real DNA of financial performance management.
Yeah, this isn't just theory. We're talking practical tools.
Exactly. Think of this as a focus mission, maybe like a diagnostic checklist for anyone needing to get a grip on controlling costs and measuring success properly. Our main goal today is pretty clear, right? We're revising the core mechanics of how you calculate basic variances, sales, materials, labor, overheads,
The fundamentals.
and then showing exactly how those deviations get pulled together into an operating statement.
The key bit being that statement has to reconcile your actual profit back to what you budgeted.
Right, and it needs to work whether you're using standard absorption costing or marginal costing. That's crucial.
Absolutely. And you can think of this whole process really as a roadmap. It helps you avoid some major pitfalls in financial management.
Roadmap. I like that.
Yeah, because every successful company, well, they need to know exactly how performance is deviating from the plan, and maybe more importantly, why it's happening. So we're basically tracing that whole chain of accountability. You calculate the variances, you connect them to the bottom line, the financial results,
And then you dig deeper.
and then you uncover the root causes. It's sort of a 5-step path, really, moving from just the numbers, the calculation, to genuine strategic insight.
Okay, let's unpack this then, starting with that foundation you mentioned, variance analysis.
Right.
So, in simple terms, a variance is just the gap, isn't it, between what you planned, your budget, and what actually happened.
That's the basic idea, yes. But for this deep dive, we need to go a bit further.
Okay.
The source material is specific. It says we need to calculate and revise variances across, well, 5 main categories technically, though they break down.
5. Okay, what are they?
Sales variances, materials variances, labor variances, variable overhead variances, and fixed overhead variances.
Right, those 5.
But, and this is important, you have to recognize that some of these immediately split further. Take materials and labor, for instance.
Okay. How so?
You don't just look at the total cost difference. You absolutely have to break it down. For materials, it's price what you paid versus standard, and usage how much you used versus standard.
Price and usage. Got it.
And for labor, it's the wage rate paid versus standard and efficiency, the hours worked, versus the standard hours for the output achieved.
Rate and efficiency. Okay, so those breakdowns are non-negotiable.
Absolutely fundamental. If you just look at the total, you miss the real story of why the cost was different.
Okay, so sales, materials, price and usage, labor, rate and efficiency, variable overheads, and fixed overheads. That's quite a few calculations already.
It is.
Now, hang on a sec. Fixed overheads. You hear managers sometimes, sort of dismiss that one.
Right.
Because those costs are fixed, right? Like rent, depreciation. They don't change much day to day. So why does this roadmap, this diagnostic checklist, insist we spend time analyzing a fixed overhead variance? What's the point?
Yeah, and that's a really common point of confusion, actually. It's probably one of the biggest misunderstandings in performance management. The thing is, the variance for fixed overheads, it isn't really a cost variance like materials or labor, not in the same way.
It's not about spending more on rent.
Not usually, no. It's primarily a measure of capacity utilization.
Capacity utilization. Okay, explain that.
Well, think about it. Let's say you budget to produce 10,000 units in your factory. That production level is used to calculate your standard fixed overhead absorption rate. Right?
Yeah, per unit.
Right. Now, what if you only actually produce 8,000 units? You've underutilized your factory. You've spread those fixed costs, like rent and depreciation, over fewer units than planned.
So each unit effectively carries more fixed costs than budgeted.
Exactly. That creates an unfavorable fixed overhead volume variance. It's not because you suddenly paid more rent. It's because you didn't use your capacity as planned.
I see. So it's flagging inefficiency or lower than expected production, not overspending on the fixed items themselves.
Precisely. And understanding that distinction, that it's about volume, about capacity, not just spending, that's absolutely essential if you want to make properly informed decisions.
That's a fantastic clarification, a real technical nugget, like you said.
Oh,
Okay,
no.
so now you've got all these different variances, calculated price, usage, rate, efficiency, volume, maybe a spending variance for overheads too.
All these individual pieces of data.
Right, the raw ingredients.
Yeah.
So how do we combine them? How do we bake them into something that gives us the big picture on profit?
Well, that's the perfect transition. That takes us straight to the operating statement.
The operating statement of
After you've calculated all those different variances, you need one single, clear way to pull them all together.
just see the overall impact.
Exactly. The operating statement is that tool. It's indispensable, really. Its whole job is to bridge the gap between the profit you budgeted and the profit you actually made.
How does it do that? Mechanically.
It starts with the original budgeted profit figure. Then you systematically add any favorable variances and subtract any unfavorable variances, all those specific ones we just talked about, properly reconciled.
Okay.
And if you've done all your variance calculations correctly, the final number must equal your actual profit. It has to tie out perfectly.
So it's more than just a report then. It sounds like a proof. It forces accountability.
That's a great way to put it, a proof.
It shows exactly which bits of the operation, the sales successes, the material cost problems, the labor efficiencies or inefficiencies contributed to that final profit number. It really is the ultimate financial scorecard, isn't it?
It really is. But, here comes a complication.
I was waiting for one.
That reconciliation, that operating statement, it needs to be able to handle different underlying accounting methods.
Okay.
Our source material specifically requires us to be able to prepare it under both standard absorption costing and standard marginal costing.
Right. Absorption versus marginal. This is where it often gets tricky for people, myself included sometimes. Let's zero in on the marginal costing approach.
Good idea.
When a company uses marginal costing, how does that change the game? How does it fundamentally alter how we use those variances to get to the actual profit?
The biggest difference, the absolute key, is how fixed overheads are treated.
Okay, back to fixed overheads.
Exactly. Under absorption costing, fixed manufacturing costs are treated as product costs.
Meaning they stick to the inventory.
Correct. They get attached to the units produced and sit on the balance sheet as inventory until the product is sold. Then they hit the P&L as part of cost of goods sold.
Okay, and marginal costing.
Under marginal costing, fixed manufacturing costs are treated as period costs. Meaning they're written off immediately in the period they're incurred. They go straight to the income statement, usually below the contribution margin line. They don't get attached to inventory.
Okay. So what's the consequence of that difference when we're reconciling profit?
Well, here's the crucial insight, the nugget. Absorption costing profit can be, shall we say, manipulated by inventory levels.
How so?
If you just produce more inventory than you sell, under absorption costing, you're effectively deferring some of that period's fixed overhead cost onto the balance sheet, trapped within that unsold inventory.
So you can boost your reported profit in the short term just by overproducing, even if sales haven't increased.
Precisely. It can mask underlying efficiency problems because those fixed costs aren't hitting the P&L yet.
Wow. Okay.
Marginal costing profit, on the other hand, doesn't do that. Because fixed costs are expensed immediately, the profit figure tends to be a truer reflection of the actual sales performance for that specific period. Only the variable costs move with the product.
So the link between sales volume and profit is much more direct under marginal costing.
Much more direct. And because of this fundamental difference in treating fixed costs, the material points out that there's a specific pro forma, a required format, for the operating statement when you're using marginal costing. You have to follow that structure to ensure the reconciliation works correctly, particularly around how the fixed overhead variances are handled.
That makes total sense.
Yes.
Management really needs to understand this, don't they? If they switch methods, or even if inventory levels just bounce around a lot month to month,
Oh, absolutely.
the profit figures calculated under absorption costing might not be truly comparable period to period. That's a massive point for internal reporting integrity.
Huge. And it flows right into the next potential complication we need to consider.
Okay, what's that?
What happens if a company decides not to value its inventory at the standard costs we assumed in our budget, but instead values it at actual cost?
Inventory at actual cost. That sounds like it could mess things up. Why is the inventory valuation method so critical when we're talking about variances and reconciling profit?
Because it breaks a core assumption we've implicitly made so far,
Which is?
that all the variances we calculate flow directly and immediately through to the profit and loss statement for the period.
Okay, and holding inventory at actual cost changes that?
It can, yes. Think about a favorable variance. Say you bought materials cheaper than standard, a favorable price variance. If that material is still sitting in inventory at the end of the period, and you're valuing inventory at actual cost.
Then the benefit of that lower cost, that favorable variance, is essentially stuck on the balance sheet within the inventory value.
Exactly. It hasn't flowed through to the P&L yet to boost the profit for this period. It's temporarily trapped, if you like. It only hits the P&L when that inventory is eventually sold.
So it changes the timing of when variances impact reported profit.
Correct. It disrupts that immediate flow. So when you're dealing with inventory valued at actual cost, the material tells us we have to look very carefully at three specific things.
Okay, what are they?
First, how does the calculation of profit itself change? Since the cost of goods sold might reflect actual costs, not standard costs, for the units sold. Second, what's the specific accounting treatment for the variances related to that inventory? Which bits stay on the balance sheet and which bits, if any, still go to the P&L immediately? There need to be clear rules.
Right, that sounds complex.
It can be. And third, the structure of the internal accounts or your chart of accounts, your ledger system, needs to be set up to handle this properly. You need accounts to track these variances that are tied up in inventory separately from those hitting the P&L. It needs internal consistency.
And I bet auditors look closely at this.
Oh, you bet they do. Inventory valuation and cost flow assumptions are always a key audit area.
Okay, that really grounds the analysis in realities.
Yeah.
So let's recap where we are. We've calculated what all those detailed variances.
Price, usage, rate,
Yeah.
efficiency, volume spending.
Yeah. We've reconciled how they impact the bottom line using the operating statement.
Cleared Ringen budgeted to actual profit.
We've adjusted for the complexities of different costing methods, absorption versus marginal.
And the impact on profit recognition.
And we've considered the curveball of valuing inventory at actual cost.
Right. Handling those trapped variances.
So now we have a really robust picture of the financial deviations. The next logical step, the real management step, is moving from calculation to action. We need to shift from the what happened to analyzing why it happened.
Exactly. That's where the learning happens. That's the most actionable part for any manager using this information.
So how do we approach figuring out the why?
Well, the material suggests breaking down the causes of variances into three useful categories. It helps structure the investigation.
Okay, 3 categories. What are they?
First, you've got general causes. These are usually broader, maybe external factors, things like unexpected inflation hitting material prices across the board, or maybe a change in government regulations that impacts labor costs, things often outside the direct control of operational managers.
Okay, general, big picture stuff. What's next?
Second, specific causes. These are much more about internal operations, direct decisions or failures that led to a particular variance. So maybe a specific machine breaking down caused that unfavorable labor efficiency variance because the team had to work around it. Or maybe a rushed purchasing decision led to buying substandard material, causing the usage variance.
Right, things you can usually point a finger at internally.
More or less, yes. But the third category, that's where the real deep understanding comes in. That's where the strategic insight lies.
Okay, I'm ready. What's the third one?
It's the interdependence of variances.
Interdependence, meaning how they link together.
Precisely. This is the aha moment for you, the listener. Recognizing these links, understanding that variances aren't isolated events, that's absolutely fundamental to true performance management. If you just look at one variance on its own, you almost always miss the full picture.
And you risk making bad decisions based on incomplete information.
Exactly. You risk making potentially damaging strategic errors.
Do you have an example of that?
Oh, absolutely. I actually saw a classic case of this in a manufacturing company once. The purchasing manager got a huge bonus, really significant, because they achieved a massive favorable material price variance.
Okay, sounds good so far. They bought cheaper.
They bought materials, I think it was about 20% cheaper than the standard cost. Looked brilliant on the purchasing report. Favorable variance. Manager gets rewarded.
There's always a but.
But that much cheaper material was, surprise, surprise, lower quality. Significantly lower quality, which then directly caused 2 other variances to blow out. They had a massive unfavorable materials usage variance because there was so much waste and scrap from the bad material.
That makes sense. More waste.
And they had a huge unfavorable labor efficiency variance. Why? Because the production team was struggling constantly. The machines kept jamming, the process was slower, they had to rework things, all because of the poor quality input.
Wow. So the saving on the purchase price was completely wiped out.
Right.
And then some.
And then some. Easily. I think the extra cost from the usage and efficiency variances was something like triple the initial saving on the price variance. But because the initial focus was just on hitting that price target in isolation,
They incentivized a decision that actually cost the company more overall. That's a phenomenal cautionary example.
it really is. It just hammers home that point. A favorable variance in one department doesn't automatically mean good management overall.
No, it might just be pushing a bigger problem somewhere else in the system. You absolutely have to look at the connections, the whole system.
You have to.
Okay, so let's pull this all together then. What does this journey mean for someone trying to manage performance? We've mapped the whole flow.
Right. We started with the detailed calculations, getting those individual variances nailed down. Price, usage, rate, efficiency, overheads.
That using the operating statement to clearly see how all those pieces add up and reconcile the budgeted profit to the actual profit.
Making sure to adjust correctly depending on whether you're using absorption costing or marginal costing.
And handling the complexities if inventory is valued at actual cost.
Then, crucially, moving beyond the numbers to analyze the root causes.
Looking at the general factors, the specific operational issues.
And, most importantly, understanding the interdependence. How a decision in one area ripples through and affects variances elsewhere.
So, by understanding this full cycle, especially those interdependencies, you move beyond just, reporting the numbers.
Exactly. You're not just explaining why the budget was missed or beaten. You're explaining the underlying business reality. You're performing strategic, holistic analysis.
This structured journey, this roadmap we followed, it really gives you the language and the framework to analyze financial performance properly, thoroughly and strategically.
It does, and maybe that leads to a final thought, a question for you, the listener, to really chew on as you apply this.
Okay, leave us with something to think about.
Well, if we accept this interdependence idea that minimizing one specific variance, say pressuring the production team relentlessly to cut labor time, if that inevitably increases costs somewhere else, maybe more material waste, maybe higher variable overheads because of rushed work leading to lower quality output,
Right, the knock-on effects.
then how can management ever really set truly isolated targets for individual teams or metrics? If everything's connected, doesn't that mean you have to manage the performance of the entire system, not just optimize individual pieces?
That's a really powerful question. Managing the system, not just the metric. A great challenge to leave us with. That's all for this deep dive.